All right, let's go ahead and get started. Welcome everybody to the stock market review for our Yummy subscribers. Any guests that are here today, welcome as well. Today, of course, is November 15th, 2023. All right, before I get going here, Jean, any comments you want to make?
Welcome everyone, and just looking forward to a great session with Bennett. That's my comment.
Okay, brief and sweet.
Also, too, yeah, short and sweet. Also, too, for everyone out there, I'd love for you all to give us a hello or a just something in the chat area. Bennett loves questions during the session, so by typing in your chat area on the GoToMeeting console, then we know you can hear us. So please give us a hello. I see a few of our regulars, Jim Blue. Hi, Kay, good to see you. John Blyer. So give us all hello. That'd be great.
Okay.
All right, Ben, back to you.
Okay, thank you. All right, so listen, I noticed on the recording last week we had some echoing, reverbing when Jean and I were both on. Is the audio okay today? Because I noticed on the recording again, it was kind of an echoing. I'm not sure. I think it was when Jean had her mic on, I had my mic on. So everything looks good now. Okay, excellent. No echo today. Perfect. Okay, so let's go ahead. I got a few administrational items, of course. I don't want to disappoint anybody. You have to have those, right? We have to talk about the risks involved in trading. Okay, so we all know there's risks in trading. The key thing is to, of course, trade with money you can afford to risk. First of all, risk capital. Have a system that you've tested and has given you an edge. And realize that we deal in a realm of probability. So even though we have a tested system, we're not going to win all the time. Sometimes we fall on either side of the probability matrix, right? So you have to protect yourself against the downside, those trades that don't work out. And this is where the entire topic of risk control comes into effect. And I think when you first start trading, you don't really realize how important that is. After you've been trading for quite a while, you do. And so if you need help in that area, we're kind of experts at that. I've been doing this for a long time, and I've written 2 books specifically on money management and risk control. And I'll show you those in a minute, but that's something you may want to pick up. So you want to be sure you're using risk control on each and every trade, because it's really hard to be profitable long-term without it. Also, too, if we look at any stocks or I give you my opinion on stocks and forecast, realize that it is my opinion. All right. And so if I recommend something, run that by your financial advisor or money manager to be sure it's suitable for you. I don't know your personal situation. They do. And so they can give you the go ahead on that or not. Also, too, of course, you want to realize that past performance does not guarantee future performance. And that goes under the probability matrix. So that's always a good thing to cover. Kind of the risks in trading. All right, so here are my books. I've got 2 on money management that may interest you if you're looking for an improvement in that area. My new book coming out and being published by Wiley is the 2nd edition of The Art of Trading. That's going to be a really good book, and you can pre-order that. Gene will put a link up, I think, in the chat area, or you can go to our website. Elliott Wave Technique Simplified is a form of technical analysis. I wrote that, and it was published by McGraw-Hill. And basically what my purpose on that book was to give you a concise and direct way in which you can count the Elliott waves. And we use the Elliott waves, we call it the roadmap of the market, so to speak, on cycles and things of that nature. And basically it assigns numbers and letters to the different movements or waves in the market. Survival guide for traders is how to run your trading business right out of your home like a professional hedge fund with today's technology. All right, so you may want to pick those up. All right, so here we are with the announcements for this week. I'm going to enlarge that just so you can see that a little better on your end. And today is Wednesday, November 15th, so we can all clap and be happy, no FOMC. All right, now we have today coming out MBA mortgage applications, PPI, retail sales, kind of a busy day. Empire State Manufacturing Index, business inventories, EIA petroleum status coming out. So that's for today. Now, yesterday, the CPI came out. The CPI was much better than most people had thought, and thus the market responded tremendously to the upside. No one was really expecting that, okay? So that was kind of a surprise. You know, the CPI numbers, we'll see if there's any legs to this. Certainly there is quite a few commentators saying the Fed is done with interest rate hikes because of that. We'll see, all right? We'll see if these numbers hold the muster. You know, they can kind of manipulate these numbers to some degree. You know, does it include certain items that we experience in living day to day? Some of those items can be excluded from the CPI. So I don't know. We'll see what happens with that and see what kind of follow through we have with that. All right, but let's jump ahead to Thursday, November 16th. We have jobless claims, Philadelphia Fed Manufacturing Index, import and export prices, industrial production, housing market index, EIA natural gas report, Treasury International Capital, Fed balance sheet. All right, then we end the week Friday, November 17th. Cooking Friday, cooking November right along here. Housing starts and permits, e-commerce, retail sales, quarterly services, Baker Hughes weekly rig count. All right, so that's kind of what's coming out. I think the big one was the CPI this week. All right, now when we look at charts, for those of you especially new here, we use software that I've created basically over the last 30 years of trading the financial markets. I have charting software that looks at price patterns called the ART software. Then we have momentum indicators and all sorts of good indicators at the bottom that help confirm signals that are generated by the ART system, and that's the OWL, PTF, TLM, and ERI. We have scanners on that middle row there, and then our risk control software at the bottom. We try to cover with our software all the major elements that you need to interpret what's going on in the market and to protect yourself with risk control. And because of that, we call it the ultimate trading system. All right, let's jump in and take a look at the most recent chart I did on Sunday before the big move up. All right, and that is, of course, on November 12th, 2023. So don't forget, as a Yummy subscriber, you have access to these charts on Sunday. Now, if you're just visiting a guest, obviously you don't have that, but this is one of the reasons people like to subscribe to the Yummy service, to get this information before the week starts. So a couple things I want to talk to you about on this chart. For those of you that have been here time and time again, this is nothing new, but we do have some new people here. So going back to 2022, all right, we had a high in the market, and that high so far has not been exceeded. So that's been quite some time that the market has been bouncing around here. That's created a lot of turmoil for a lot of people. And in terms of that Elliott wave I was talking about, remember the book with the Elliott wave? So we assign on the daily chart, this was the fifth wave of the Elliott wave. And there are 5 waves in a trend on the Elliott wave. So that marked the end of a significant move up on the daily chart. But it also, at that point, ended a significant wave up on a higher time frame called the weekly chart, which was a wave 3. So after this top, which was significant, occurred in 2022, the market has sold off and sold off drastically after this high. And basically, we had another 3-wave, 5-wave sequence, which marked the end of A wave. So A waves and C waves and E waves have these 5 waves in them. The B's and the D's are a little bit different. So we had this type of situation here for a B wave. Then we had another 5 waves down, but the 5th wave failed, and therefore it created a failed wave C. 90% of the time, maybe 95, I don't know the exact statistic, but it's up there. We normally have on a correction just an A, B, C, and that's it. So C wave takes us down to the target zone, and that ends the correction. However, in this situation, that did not occur. And we really didn't know that was not going to occur until we started heading up, getting past the 50% inflection. Because most of the time, what happens is you have a little profit taking and then more movement down. But this thing kept going up. And as soon as it got above B wave, that stuck it into what we call a complex correction on the longer time frames. So these A's these B's, these C's, and possible E's are all part of the actual longer term wave count on the weekly chart. So then after that went above B wave and determined we were in a complex correction, that obviously meant it was D wave. Now, we were watching very closely here to see just how high D wave would go. Would it take out the all-time market high? That happens very rarely. So if that would be the case, that means this correction would be over and we're going to go ahead and make new highs. And the only thing about this correction was it was a minor correction, not a major correction. All right, well, it got to that top that we've labeled D and then it sold off again. All right, okay, that kind of was expected if this is a long-term corrective market. So then it bounced off there last week and created another minor support here at 32,327 with a more major one under it at 31,429. All right, but then here we have a top here of D wave that we're keeping an eye on at 35,000. All right, 679. 10. Okay, so we're going to watch and see if that holds. Well, we had a big week up, so we're going to take a look at the live charts in a moment and see exactly where we are on that. All right, so if we go above this, then we have to slide this possible D wave over to here. Now, if this holds and we get more selling coming in after that, then that just means that all this bullishness that the CPI created is just all part of this ongoing complex correction, provided selling comes in at some point before the all-time market high of 36,952.65. Now, you can cut on the news, you can go to YouTube, and you'll have people that are very definitive in certain forecasts. I kind of like to stay away from that. I kind of like to let the market tell me what's going on. I've been humbled way too many times in the market to come on with an attitude that, I know what's going to happen. Because, quite honestly, we don't. If we did, we'd all be sitting on, 150-foot yachts enjoying our martinis, okay? It would be that simple to do it, but we don't, okay? So we're stuck with working in this realm of probabilities and following the market. And so this is how I do it. I mark significant resistance levels, which are these in the green up here, and support levels, and then I wait, kind of like a spider with a web, for the market to hit the web, and then I go with it, okay? So if it's bullish, it'll be bullish. If it's bearish, it's bearish. So that's kind of the way I, analyze the markets and take a look at things. Let's just say if the market does go up a little bit more, but does not go past this and instead turns around and heads down and starts breaking these support levels. All right, then this is the next one, which is the bottom of this failed C that we really want to keep an eye on if that happens. If that happens, then that indicates that we're probably going down big time in wave E. And if that happens, I'm thinking of a bottom on the Dow around 18,000 to 15,000. That would be a huge correction. However, okay, if you take into consideration that we had a 13-year bull market that could have possibly ended in 2022, that level I gave you was basically within a Fibonacci retracement on that bullish move. So it's not so outlandish when you think about where the fibs are drawn on that 13-year bullish market, okay, or bullish wave 3. So it is a possibility, a real possibility. It's not a number I'm just making up, so to speak. It's one that is supported by some fib retracements, okay? So that's kind of where we're at now. All right, also too, it's no surprise that we've kind of got an end in, this is the 60-minute chart. So if we came down here, and this was a fifth wave inside, if you remember a couple weeks ago, we had this labeled as a target. So it hit there. Now it's moving up. So if D wave holds, which is this top here, then that means that this probably has to be a wave 2 because it's gone too high at this point for a retracement. So if it is a wave 2, it could come right up to the top of D wave before it turns. All right, so we're going to keep an eye on that. That's just a possible Elliott wave sequence that it could be. All right, in the S&P, these are 3 time frames, the 60, the daily, and the weekly. And here's our all-time high, even on the S&P. All right, and we've gone up since then, of course, here. But again, as long as we don't break this part, there is a very valid argument for a long-term sell-off here. Okay, so you have to keep that in mind. I'm not going to take that off the table until we get above the all-time high on both of the S&P and the Dow. Okay, and the S&P will probably lead the Dow a little bit. It usually does. Now, like the Dow, our indicator down here, which is called the PTF indicator, this indicator has a 75% accuracy rate, so it's pretty damn accurate, but it just doesn't tell you when it's going to happen. But basically, it was triggered on the COVID low back in 2021, right? And what's that saying is during the next major correction, which we think we're in that now, it just hasn't unfolded enough yet, that we should take that out. And that would bode for the case of hitting that Fibonacci retracement that we're thinking about on the weekly chart. So that's kind of where we are now. And that's the S&P. That'll be the S&P and for the Dow. Now, the NASDAQ has been a different critter, okay? The NASDAQ here is, this is our target for the NASDAQ. More bullish than the S&P and the Dow, and it's obvious why, because it has all the big tech stocks in it, right? All right, so we're thinking more highs on the NASDAQ. And if you're going to get more highs on the NASDAQ, that's probably going to keep the overall market in this range, if not a little higher. So I don't think, people say, well, gee, next week this thing's going to sell off. No, I don't think you can say that. I think you got to be a little careful here, because if this NASDAQ does what I think it's going to do, which is go higher, all right, I think it's going to bolster the entire market, including the S&P, the Dow, and most of the other indexes. It's going to keep it rather high, okay? So I don't think you're going to see an immediate sell-off until that happens. So we'll keep an eye on that, and we'll keep watching that, and I'll let you know, of course, when I think that's going to happen. All right, quick little statement. Once again, let me just open this up a little bit. Quick statement on the Case-Shiller Home Price Index. Let's do this, zoom to fit. All right, so this is something I like to look at on the housing market. And I showed this before, but again, if you're new here, the red line is the Case-Shiller Price Index for the United States. Okay, so that's giving you home prices as an average for the U.S. All right, and I update this every week for those in the Yummy, so you get the newest one. The bottom line is, of course, our CPI. Okay, so it'll be interesting to see how that updates now that that's come out. All right, so what we've noticed here, what you can take away from this, during a fairly orderly period, prices, okay, usually stay or kind of hug the CPI. Well, in the year 2000, all right, things started changing, okay? So prices of homes went way up until it topped in 2008. Now, why did it take off here? Well, let's think about what happened, all right? You can blame a lot of this, obviously, for lower interest rates, okay? Interest rates were kind of low at that point. But the main thing here was that during the mortgage application process, there was no income check, if you recall. That's what caused the problem of the financial crisis. The banks got very, very less strict, so to speak, on qualifying for a mortgage, so everybody could qualify. And a lot of times, once you were in a house, you also had the equity loans, and basically, if you could breathe, you would get the loan. No joke, okay? And of course, that caused the problem. And here we note that prices on the Case-Shiller got significantly higher than the CPI. Whenever that happens, it usually has to pull back to pull back to more of a mean, where it's going to be closer to the CPI. So it did that, and then once it corrected, and it's fairly decent here, okay. Not as good as here, but fairly decent, about the same as here, okay? And then it started going up again. So housing started to recover, okay? And off it went. Then you had COVID. Rates were still pretty low. Then you have COVID, and that just accelerated, okay? So now look how wide the gap is. If history is any indication of what will happen, all right, it should start to come back to the mean at some point. So that means the housing situation should start to correct. What could cause it? Okay, 100 reasons why, okay? But when I look at a graph like that, I just take a look and see, what happened, what has always happened before, which it always reverts back to the mean. Now, you always have some people that come out and they said it. I remember that during the dot-com bubble in the stock market, one of the biggest lines that came out of that dot-com was that things are different now, okay? Things are different now, all right? And that was a classic line back in the year 2000 to classify the fact that technology was coming to the forefront. And even though stocks got a very, very high multiples, things were different now, okay? So everything was justified. And of course, what happened, you had the dot-com bubble burst, the technology burst, and the market halved itself, went down 50%, okay? So, and they're saying that again now about the housing market. So I'm always skeptical when I hear that. Could it be different now? All right, I'll keep an open mind, maybe, all right? But I doubt it. Not if you're gonna go off history and what usually happens. So if this were to go back to its fairly normal area, it would have to correct about 40%, all right? So we'll see what happens. But I'm very skeptical on the housing market being able to sustain itself. And right now, from my understanding, is obviously the supply. I think everybody knows this if you keep up with the housing. The supply is low, but so is the demand. All right, people aren't rushing to get mortgages at these interest rates. Now, if the Fed drops the interest rates, which is what people are saying is going to happen, the Fed is done, they're going to start dropping interest rates next year, later part of next year, then that could change things again, but we may get a correction before that happens. Now, if the economy slides into a recession and people lose their jobs, then they may be forced to sell their homes even though they don't want to. Because a lot of people have homes where they have a very attractive interest rate they had gotten back when interest rates are very low, so they're not selling their home. That's why the supply is so low in the housing market. But if they're forced to, that's going to flood the market. And if that happens, then that's going to increase supply, which will decrease prices. So who knows what's going to happen, but I can certainly tell you from most people that I talk to, they think the housing market is just absurd right now in terms of who can afford it, all right? The only people really moving up at this point are people that have made so much money on their current house that they sell and can take that cash and re-buy it without a mortgage, okay? But that activity is out there. But for new people trying to get into a home and are trying to afford it based on their salary, really tough at this point. So they're forced to kind of rent, I guess, at that point. So it'll be interesting to see what happens with this, but beware and keep an eye on this. And this is out there publicly, so you can look this up. All right, let me just dump out of here real quick. So I want to go into the Dow here for a minute. And here's the current charts. All right, so here's our D wave high. All right, so you can see we've moved up quite a lot, but we're not taking out the D wave yet, okay? We still got red here, all right? We have bullishness here. I think what's going to be very telling on this is, like I always tell my clients, after you have a big move up here, is this an ABC that could dwindle out and come down? Possible. All right, but let's wait for the next pullback and see what kind of strength it has. If it comes back up and takes that out, that's pretty bullish, and that may mean we'll take out the top of D. If, however, it doesn't do that, but instead we get something like this and it heads down, then we may test the lows and come back down and see what happens then. So I guess what I'm trying to say is, did the CPI create a short-term bounce in the market, or is this going to have legs? Watch the patterns that the market creates to answer that, because I don't know, and neither do you. Okay, so we'll certainly have to see. All right, and the S&P is the same. NASDAQ is come up quite a bit as well, reaching its way near our target. So we're getting close. Okay, so we could get these NASDAQ stocks could get up here. All right, and still not take out their high. Okay, the high is way up here. So I'm thinking that's what's going to happen. And when we get to this target on the NASDAQ, then that should be the end of the move. And then we should see something more dramatic to the downside. So overall, I guess if you want to take away my thoughts on the market here, I think we're in a long-term bearish market witnessing a corrective rally inside that bearish market. Okay, so that's kind of what I'm thinking on that. All right, so that's my opinion. All right, you may disagree, and that's what makes a market, but I think that's kind of where we're at now. All right, let's see what folks are saying out there. All right, let's see. Yeah, Frank saying AI driving tech stocks up. Sure, that's the times are different type of thing these days. All right, just like you're saying Bluetooth cell phone IT explosion 99 and .com. Okay, also. All right, TLT. Let's take a look at TLT. Now, TLT is the bond market. Well, it's the ETF for the bond market. Okay, so we're starting to see some bullishness in bonds right now, obviously, okay? But again, I'm not seeing this based on my indicators here that the bottom is in yet. And the reason I say that at this point is because we have a bearish PTF. Don't forget, 75% accuracy. So what this, and how you read this indicator is basically find the lowest price in that red area that's current. Okay, yellow's neutral, so that's that doesn't hold anything. But when we have a red like this is the lowest low in that red area, and that's the bottom. Okay, so it's saying that, yeah, we may get a rally here, but that's all it's going to be, is a mild profit-taking rally, correction, whatever you want to call it, and it could go up quite a bit higher. Okay, but according to that indicator, it's not the bottom. And here's what's kind of interesting, and this is kind of why I rely on it. You know, many people thought there was a bottom here, but look at this, it was red here as well. So we kind of went up here. All right, people thought, oh, Ben missed it, you know, it's rallying, and then look what happened, boom. And then this indicator was correct. So it went from a red to a yellow, indicating it was accurate. All right, so whenever it goes from a red to a yellow or a green to a yellow, it worked, and it does that 75% of the time. All right, so, okay, is there a trade here? Maybe short term, okay? Maybe if you go down to the 60-minute chart and draw your fibs in, you might have a short-term trade in there, but I'm not too excited about it, all right? So let's take a look at USO. That's a good one too. And of course, this is the ETF for oil. All right, so oil, you know, has been coming down, all right, and still coming down. You can obviously feel that at the pump, right? Prices have come down. Again, long term, we think prices should reverse and go back to the upside. Now, I've drawn in a fib retracement based on this move up here. There's your ABC correction. We may have a bottom in, but this is saying no. Okay, see this little red PTF here? That's why I look at 3 time frames. Kind of helps me. So I'm thinking we're going to go head down again. So prices are going to continue to come down one last time. This should be the last leg, I think, on its move down. And if the reason I say that is if I go inside, if this is a B and we're in C, let's see, 1, 2, 3, 4, 5, maybe, okay? An NC wave, because there's 5 waves. So I think one more leg down should do it on oil before we get a bullish return. My target long term on oil is, you know, between $98 roughly and $125. So that's it there. All right, URA, and then we'll wrap it up with these two, URA, ATLX for Frank, for you. All right, so this is pretty bullish still, okay? Pretty bullish. So we drew in some fib possibilities here. It came down, hit that. Looks like it's going to make one more leg up. What's interesting with this, just so you know, when you get near a top, look for the hook. Okay, that's the hook, because that's always the minor four or major four sometimes in the last move up. So one more move up on this, and then we probably will see a maybe the end of the move up for a while. Okay, ATLX. Let's take a look at this bad boy, and this one here starting to waffle. Okay, it's been waffling actually all summer. Started moving down. We have a red PTF on the 60, so I think it's going to come on down, Frank. So that's where I'm at now on that. Long term should recover, but short term I think we're going back below 20 for a little bit. All right, so that's kind of where we're at now. One more thing I want to take a look at is silver, if you don't mind. I know we're a little over. You know, a lot of people had people buy silver in the, if you went on YouTube, they were pounding the table to buy silver at 26 bucks. I'm not in a rush to get into silver. Long term, will silver do good? I guess. But I'm not in a rush to get it. We've got a pennant forming on the long-term weekly chart. So we should break out at some point pretty soon. So we'll keep an eye on that. And if we do that, then I'll maybe get more excited about silver. But I'm showing some bearishness here. Okay, here. A little bit of bullishness, a little further up. We got a green here, so a little further higher there. But we're still waffling, you know, inside all these channels here. That should resolve itself a little bit to the downside. So I wouldn't be in a rush to get into silver, okay? And if things change and it looks really bullish, well, guess what? We won't miss it because we're going to be looking at it, all right? So if it breaks to the upside, our indicators are going to catch it, and we'll take a look at it as a buy then. But I would save your money and stay out of silver for right now. Now, if you're accumulating silver for the long term, okay, fine, all right? So prices are pretty stagnant. You could probably get a pretty good price on it. But you might even get a better price if we come down a little bit on it. That's all I'm saying, all right? All right, well, that is it for today. I hope you enjoyed today. We have the client support webinar coming up in about, about 30 minutes. And today we're gonna cover the pyramid trading points. I've gotten a lot of emails for people to ask me to go over that again. I haven't done that in a while. And last week we went over the art reversals. So I hope to see many of you there today. And of course, bring any questions that you have, because that's the purpose of the client support. All right, well, thank you everybody. Gene, I'm gonna turn it back over to you. This was recorded, and we'll put this up in the usual places. Have a good week. And I guess I get to see you one more time, I think, before Thanksgiving. So hope everybody's gearing up for the holidays. Okay, so Gene, back to you, and thanks everybody.
Great session, super. And of course, everyone, this is recorded and we post it in the Yummy Room, and also we post it on YouTube, on our YouTube channel, so you can join us there. And we'd love to have you join us for Stock Analysis Fridays on YouTube. That's every Friday at 8 a.m. Pacific. And it's a terrific opportunity for you to find great picks. Every single week we find really great picks, so love to see you there, and I will post the link for that. See you soon. Bye.